Hey, stop scrolling for just a second. I need about 12 minutes of your time because what I'm about to share with you could literally save you thousands of dollars every single year, and it's 100% legal. What if I told you there are completely legal ways to pay zero tax on your investment gains, not loopholes, not offshore accounts, straight up zero tax legally? I'm not talking loopholes, not shady offshore bank accounts hidden in the Cayman Islands. These are strategies that the government specifically put in place for regular, everyday Americans, people just like you. And here's what's going to genuinely surprise you. Most people never use these strategies, not because they're complicated, but simply because nobody ever told them until right now. In the next 12 minutes, I'm going to walk you through 5 real, practical, totally legal strategies to keep more of the money you make from an investing. Stick with me, or this could seriously change your financial life. But real quick, before we get into it, one important and honest heads up. I am not a tax professional, and nothing in this video is personal tax advice. Everyone's situation is a little different, and tax laws can vary. Always run your specific situation by a qualified tax advisor or CPA. But the strategies I'm covering today are well documented, completely above board, and actively used by millions of everyday investors. These are not secrets locked away for the wealthy or the financially elite. They're tools baked right into the tax code, built for everyday people like you and me. All right, let's jump into strategy number 1. Strategy 1. The Roth IRA, the Stocks and Shares ISA, and the Roth 401k. This is hands down the single most powerful legal tax strategy available to everyday investors in the United States and the United Kingdom. Here in the United States, money inside a Roth IRA grows completely tax-free. Every dividend, every capital gain, every single dollar of growth inside that account, the government cannot touch it. And when you retire and take it out, still tax-free. Here's a number that should genuinely stop you cold. Put in $7,000 a year starting at age 25, and by the time you hit 65, you could be sitting on $1.8 million. And every single cent of that is yours to take out completely tax-free. Over in the United Kingdom, the equivalent is the Stocks and Shares YSA. You can put in up to £20,000 every single tax year inside this account. Every pound of gain, every dividend payment, every withdrawal, zero tax, forever. If you're not already maxing out your ISA or your Roth IRA every single year, you are voluntarily handing money over to the government that you legally do not have to give them. Let that sink in for a second. All right, strategy 2. Now let's get into strategy 2. And this one is available to investors in both the United Kingdom and Australia. And honestly, the numbers here are absolutely jaw-dropping. Strategy number 2, the capital gains tax-free threshold. Now, this one specifically applies to investors in the UK and Australia, and it is one of the most powerful and most overlooked allowances in all of personal finance. In the United Kingdom, every single person gets an annual capital gains tax allowance. For the 2025 to 2026 tax year, you can cash in up to £3,000 in investment gains, completely tax-free. Savvy investors plan their gains around this allowance every single year. They cash out gains right up to that limit, keeping it all completely tax-free, then reset their cost basis and start all over again, year after year after year. Over in Australia, it works a little differently, but it is just as powerful. Hold an investment for longer than 12 months and you automatically score a 50% capital gains tax discount. If your tax rate is 32.5%, you effectively pay only 16.25% just by waiting one extra year. Strategy 3, tax loss harvesting. This is a strategy that wealthy investors quietly use during every single market downturn, while everyone else is panicking and losing sleep, and it is completely available to you starting right now. Here's how it works. If you own investments that are currently worth less than what you originally paid for them, you've got an unrealized capital loss sitting right there in your portfolio. When you sell that investment, you lock in that loss. And that locked in loss has real, tangible dollar value. You can use those locked in capital losses to directly cancel out capital gains you made in the same tax year. And here in the United States, you can even deduct up to $3,000 of net capital losses against your ordinary income. That's the money from your regular job and paycheck every single year. And here's where it gets even better. If your losses go over $3,000 in 1 year, you do not lose them. You carry them forward indefinitely and use them against future gains down the road. This is how smart investors flip a rough market into a tax advantage. I know that might sound a little abstract, so let me make it crystal clear with a real world dollar example. Because when you see the actual numbers, you'll get it immediately. And you'll understand exactly why wealthy investors do this every single year. Here's the scenario. You sold Fund A this year and walked away with $10,000 in capital gains. Normally, at a 20% long-term capital gains rate, you'd owe $2,000 to the IRS. $2,000 just gone. But you also own Fund B, and that one has dropped in value. You're currently sitting on an $8,000 unrealized loss. So here's what you do. You sell Fund B, you lock in that $8,000 loss. Your net taxable gain is now only $2,000 instead of $10,000 at a 20% long-term capital gains rate. You owe just $400 in tax instead of $2,000. You just put $1,600 back in your own pocket, legally, in minutes. And here's the key move. You immediately buy back into a similar but not identical fund. You keep your full market exposure. You don't miss a single day in the market, but you just legally slash your tax bill by $1,600. That right there is tax loss harvesting in action. Strategy 4, the 0% long-term capital gains rate, right here in the United States. This might be the most powerful and most slept on strategy in all of American personal finance. And the vast majority of people have literally never even heard of it. For the 2025 tax year right here in the US, if your total taxable income comes in below $47,025 as a single filer, or below $94,050 if you're married filing jointly, your long-term capital gains are taxed at 0%. That means lower income investors, folks in early retirement with low taxable income, can sell appreciated investments and owe absolutely nothing in capital gains tax. 0. This is one of the most overlooked strategies in American personal finance. Check your bracket every year. If you're in early retirement with your spending under control, or taking a gap year, or your income genuinely dips below that threshold, this one strategy alone could save you tens of thousands over your lifetime. Check your income bracket every single year. Strategy 5, dividend investing inside tax advantage accounts. And this one all comes down to one elegant, simple concept called asset location. It's not about what you own, it's entirely about where you're holding it. Dividend income gets taxed in most situations when it's earned inside a regular brokerage account. Every quarter, every dividend check, Uncle Sam takes his cut, year after year, compounding against you the whole time. But if those exact same dividend-paying stocks and ETFs are sitting inside a Roth IRA, a stocks and shares ISA, or an Australian superannuation account, those dividends are completely protected. That money stays right in your account. All of it. Every single cent. The simple rule of asset location is this. Put your highest yielding, most tax-heavy investments inside your tax-sheltered accounts. Keep your tax-efficient investments in your regular brokerage accounts. This one simple repositioning can save you thousands of dollars a year without changing a single investment you own. Now, before you go run off and start tax loss harvesting, there is one critical rule you absolutely have to know first. It's called the wash sale rule. And if you trip over it, you will lose the exact tax benefit you were trying to get. The wash sale rule here in the United States says, if you sell an investment at a loss and then turn around and buy the same security or something substantially identical within 30 days before or after that sale, The IRS will throw out your loss claim. It just disappears. Gone. The fix is straightforward. Just buy a similar fund, but not the exact same one. For example, sell your S&P 500 index fund, then immediately pick up a total market index fund. Different fund, same kind of market exposure, zero wash sale issue, problem solved, completely by the book. It's all right. You now know 5 powerful, completely legal tax strategies, but knowing is only half the battle. Here's your 3-step action plan for today, right now, before you close out this video. Pull up your accounts. Let's do this together. Action 1. Open your accounts right now and take a look at how much of your money is sitting inside tax advantage accounts versus regular taxable brokerage accounts. If most of it is in taxable accounts, you are leaving a ton of money on the table every single year. Action 2. If you're a U.S. investor, take a look at your estimated taxable income for this year. Are you coming in under $47,000 as a single filer? If so, you could qualify for 0% capital gains tax right now. That one annual check could completely change your financial picture. Action 3. Scan your portfolio for any unrealized losses before the tax year wraps up. Do you have any positions sitting in the red? Those losses have real dollar value. Harvest them now. Use them to offset your gains. Don't let the year-end deadline slip by without taking a good hard look at this. These 3 actions together, checking your account breakdown, checking your income bracket, and harvesting unrealized losses, have put thousands of real dollars back in real investors' pockets. Not someday, right now, this tax year. The only question is, are you actually going to do it? Here's the closing truth I want you to take with you today. Every single dollar of tax you pay when you didn't have to, is a dollar that no longer works for you, a dollar that no longer compounds, a dollar that no longer builds the future you're working so hard toward. Tax efficiency is not tax avoidance. It's not gaming the system. It's not a gray area. It's using the rules exactly the way the government designed and intended them. For everyday people, these strategies exist for you. They're legal. They're documented. Use them. If this video gave you something valuable, hit the subscribe button, leave a like, and share this with one person who needs to hear this today. Because the people who understand this stuff keep more of what they earn. And now, you're one of them. Thanks for watching, and I'll catch you in the next one.